A guy invests money into a basic S&P 500 index fund, then disappears. No trading, no stock picks, no crypto, no 7 passive income streams. 30 years later, he comes back a multi-millionaire. Meanwhile, most people who actively tried to beat the market failed. Which raises a weird question. If the simple strategy works so well, why do so many people destroy it before it pays off? That's what this video is really about.
The big lie about investing. Most people think investing is about intelligence, timing, picking winners, or finding hidden opportunities. It's not. The hardest part of investing is surviving your own emotions long enough for compounding to work. Because wealth creation is deeply boring at first. And boring makes people impatient.
The invisible machine. Imagine building a machine that earns money every day, whether you work or not. At first, the machine is tiny. You feed it money every month. $500, $800, maybe $1,000. And for years, almost nothing exciting happens. That's the stage where most people quit, because the progress feels painfully slow. But what they don't realize is this. Compounding is front-loaded with boredom and back-loaded with shock.
The first 10 years.
Let's say you invest consistently for 10 years. You look at your account expecting life-changing money, and instead you see numbers that feel underwhelming. You sacrificed, you stayed disciplined, but your portfolio still feels small. That's the psychological trap, because people compare slow wealth to fast stories, crypto millionaires, real estate flips, overnight success. So they abandon the boring system right before it becomes powerful.
The turning point.
Then something strange happens. At a certain point, your money starts growing faster than your contributions. That's when the game changes. You're no longer the main source of growth anymore. Your capital begins working harder than you do. And once that happens, time becomes more important than effort.
The mistake everyone makes.
Most people don't fail because investing doesn't work. They fail because they interrupt the process. They panic during crashes. They chase trends during bull markets. They constantly optimize a strategy that already works. And every time they do that, they damage the compounding engine.
The real enemy isn't the market.
People think market crashes destroy wealth. Historically, that's usually not true. Markets recover. The real damage comes from investor behavior. Selling in fear. Buying in excitement. Jumping in and out constantly. That behavior gap costs the average investor enormous amounts of money over a lifetime. Not because the market failed them, but because emotions did. Why boring people get rich. The funny thing is, the people who quietly become wealthy are usually the least exciting investors alive. They buy index funds, automate contributions, ignore headlines, and keep going for decades. That's it. No drama, no predictions, no next big thing. And yet, those people often outperform the majority of active investors. Because consistency beats intensity when intensity isn't sustainable. The hidden costs.
There's another problem almost nobody notices. Tiny percentages quietly stealing massive amounts of future wealth. High management fees, frequent trading, taxes from constant buying and selling. Individually, they seem small, but over 20 or 30 years, those tiny leaks become hundreds of thousands of dollars. Compounding works both ways. Good habits compound wealth. Bad structures compound losses.
The most dangerous phase.
Ironically, the biggest danger often comes after someone succeeds. Retirement. Because once you stop contributing and start withdrawing, market crashes become far more dangerous. Early retirement losses can permanently damage a portfolio if withdrawals happen during downturns. That's why smart investors prepare years in advance, building cash buffers, reducing emotional decisions, and planning withdrawals carefully.
The core message. Here's the truth almost nobody wants to hear. Building wealth is usually not about doing more. It's about interfering less. The system already works. Historically, patient long-term investing has created enormous wealth across generations, but only for people willing to stay in the game long enough. Most people quit during the boring years, right before the compounding curve turns vertical, right before the machine becomes powerful, right before the money starts working harder than they do. The irony is that the greatest financial strategy ever discovered looks incredibly unimpressive for a very long time. And maybe that's why so few people stick with it. The people who do, they usually spend their 40s looking financially average, and their 60s shockingly wealthy. Because in investing, doing nothing is often the hardest thing to do, and sometimes the most profitable.